Pakistan's economic lifeline, its $7 billion International Monetary Fund loan program, faces a critical review this week.
A delegation from the global lender is in the capital to assess whether Islamabad has implemented the necessary tax and structural reforms agreed on to unlock the next installment of the loan.
Now, the funds are key for the nation grappling with a prolonged economic downturn. Hira Mustafa reports.
Pakistan has borrowed from the IMF more than 20 times since 1958 and is now its fifth largest debtor. But last September, Islamabad secured its largest loan from the global lender, yet for $7 billion. To get that funding, Islamabad had agreed to a number of unpopular measures, including increased taxation on citizens and businesses, the introduction of agricultural taxes, higher energy and electricity prices. On this visit, the IMF delegation will conduct the first review for that loan program. Islamabad's compliance with taxation targets and its progress on structural reforms from last July till December will be the focus of the global lenders delegation. And if Pakistan passes the test, it will then get access to $1 billion, the second tranche of funds. The government says it is committed to fulfilling obligations made to the global lender, but some conditions will only be implemented later in the year. Experts say Pakistan has not yet executed conditions like bringing in an agriculture income tax and taxing retailers. They warn that the stakes are high for Pakistan and it's crucial to show tangible progress to the IMF.
One of the major challenges that Pakistan faces in all the IMF program previously implemented is this boom and bust cycle, where we follow IMF program in the first phase of the IMF program with letter and spirit, but in the later stage we start to deviate from it and we again opt for the political discretion over the economic rule. So we need to bring consistency.
The government admits Pakistan's economy needs external financial assistance to bounce back and credits the IMF loan for helping to stabilize the economy. Inflation eased to under 3% in January compared to 24% in the same month last year. But economists say the IMF delegation will push for strict implementation of tax reforms, highlighting that Pakistan's current stability is largely due to IMF loans and therefore unsustainable in the long run. Experts say Pakistan also needs to devise strategies for long-term national debt reduction.
Pakistan has this huge national debt. Obviously, this is sustainable debt as per the IMF, but still we require these fiscal injections, these structural reforms, so that we stop the bleeding, we stop the loss making. Pakistan needs a long-term program so that these structural goals are achieved.
Struggling with financial constraints, the cash-strapped country is desperately seeking aid from other global lenders and has started reaching out to countries in the Middle East and in Southeast Asia to diversify its trade partnerships. The government claims Pakistan's economy is on track to recover and is optimistic about securing the second installment. However, many Pakistanis believe these reforms, particularly the hike in electricity prices, have hit the common man hard, exacerbating an already dire situation where 40% of the country's population lives below the poverty line. Hira Mustafa, CNA, Islamabad.